A few days ago, Bloomberg warned empty office buildings have become a, quote, debt time bomb. The piece kicks off with owners of gleaming office towers in San Francisco walking away from their debt while San Fran's largest mall was just abandoned by its landlords, leaving a $558 million mortgage. Two hotels were defaulted, leaving $725 million in debt, while a $1 billion portfolio of apartment buildings was just stiffed. Happily, Bloomberg fingers the culprit: cheap debt. In fact, Mises Institute economist Mark Thornton maintains a recession tracker, the skyscraper index, that flashes red whenever a world's tallest building is born, as in cheap money overbuilds and ends in recession and real estate disaster every time. Bloomberg mentions that nationwide $1.4 trillion in commercial real estate loans are due this year, and those loans are a mainstay of regional banks that are already holding on by their fingernails. Meanwhile, commercial real estate prices are now plunging, with institutional quality offices losing 27% in the past year, apartment buildings down 21%, and malls down 18%. And going by 2008, it could take years for prices to recover. One major analyst thinks 10 years. In fact, one study from Columbia and NYU says these prices will never recover, that remote work will permanently devalue property in cities like New York and San Francisco by half. That would mean a whole lot of abandoned buildings and defaults, especially older buildings with higher maintenance costs. If you've ever been to New York, older buildings with maintenance issues describes most of the city. Of course, this all hits urban tax revenue, which then drains public services like police, trash collection, cleaning streets of used needles, and poop, all leading to a, quote, urban doom loop of people fleeing with an assist from violent crime and what Bloomberg calls, quote, highly publicized retail theft. Just the other day, somebody caught a cell phone video of a shoplifter in San Fran using a blowtorch to defeat locked shelves in a touching end of empire vignette. This urban doom loop is now coming for second-tier cities as well. So Atlanta tenants vacated almost 300,000 square feet of downtown Class A office space last year. 31% of Atlanta office space is now vacant. Fully a third of Atlanta's office space debt is maturing in the next 18 months, and if it's empty, it is probably going to default. Even Austin is getting hit with 6 million square feet empty, and Denver and Houston are seeing big defaults. Europe is not nearly as bad as the U.S. They haven't killed their cities as enthusiastically, but higher lending costs are even hitting London, with defaults on trophy buildings in Canary Wharf, that's London's Wall Street. And I mentioned a couple months ago that Sweden's largest landlord was downgraded to junk with $13 billion in debt, while landlords are struggling in Sweden to roll over $42 billion in debt. That's in a country smaller than Ohio. While work from home will grab the headlines, every boom-bust cycle hits real estate hard. This time it will be magnified, yes, by work from home and by the third-worldization of American cities to satisfy utopian activists who almost seem to root for the violent criminals and against the middle class. If you happen to be stuck in one of those dying cities and you are not a violent criminal, it may be time to leave. And in the meantime, that debt time bomb will be hitting the already fragile regional banks. Okay, we'll be watching. See you next time.